The pound is continuing to outperform at the start of this year. It has resulted in cable rising back above the 140 level, while euro sterling is grinding lower towards the mid-80s. The pound's current upward momentum is not a new trend. It has been one of the best performing global currencies since last summer, and we continue to see scope for further gains in the near term. The pound is currently deriving support from favourable seasonals. There has been a clear seasonal pattern of pound outperformance during April. Cable has risen for 13 consecutive years in the month of April by an average of 2.3%. The pound has also tended to strengthen against the euro, although by a lesser extent. It is providing further encouragement for leverage funds to increase long pound positions. The stronger pound continues to reflect two main fundamental drivers. Firstly, there has been a clear progress in Brexit talks since late last year. Most importantly, the EU and UK recently agreed in principle to implement a Brexit transition period until the end of 2020, which would maintain the current status quo for trading relations. The encouraging Brexit developments have significantly reduced the likelihood of a more disorderly no-deal outcome, and thereby downside risks for the pound in the year ahead. Secondly, the pound is deriving more support from higher UK yields. The real inflation-adjusted policy rate in the UK had become deeply negative. It is now moving higher, both in response to the Bank of England's plans for further gradual rate hikes and an easing of elevated inflation pressures in the UK. We expect the Bank of England to follow through on recent hawkish policy signals and raise rates again in May. The Bank of England has become more confident that growth in wages and unit labour costs will pick up to target consistent rates. We do not expect any weather-related economic weakness in Q1 to materially alter the Bank of England's outlook for policy. Indeed, further progress towards a smooth and orderly Brexit should encourage the Bank of England to deliver multiple rate hikes this year. In contrast, external developments have become less favourable and could potentially undermine our outlook for a stronger pound in the year ahead. The building risk of a global trade war is contributing towards a pickup in financial market volatility. The UK's current account deficit remains sizable, even though it narrowed materially to 4.1% of GDP last year. It could leave the pound vulnerable if there is a further marked deterioration in external financing conditions. On balance, we continue to expect the pound to strengthen further, lifting cable back towards the 150 level in the year ahead. Our outlook for a stronger pound rests on two key assumptions. Firstly, the Brexit transition agreement is implemented, and secondly, a full-blown trade war does not materialise.